Take a moment to observe the graphic displayed on your screen. Disregard the price indications and focus solely on the depicted line. Note that prominent vertical surge originating from the apex of the candlestick formation. This isn't merely a line, it signifies a highly irregular event. The price of silver experienced a dramatic and instantaneous leap to $83.71. It didn't ascend gradually, it virtually materialized there. One moment the price stood at $79 and the very next it was $83. Then, with the same startling rapidity with which it ascended, the foundation gave way. The price plummeted from $83.71 all the way down to $74.47. This represents a $9 fluctuation within a single trading session. If you are a novice investor, you are likely experiencing significant apprehension. Upon witnessing that decline, you might be convinced that the upward trend has concluded, that the speculative bubble has burst. However, if you are a seasoned participant, one who has weathered the market shifts of 1980 and 2011, you will recognize this event precisely for what it is. This was an orchestrated endeavor to trigger stop-loss orders, a deliberate algorithmic maneuver designed to liquidate traders who had leveraged their positions and chased the opening gap on Sunday night. Financial institutions observed the diminishing liquidity during the period known as Ghost Week. They noted the paucity of available orders in the book. Consequently, they allowed the price to surge to $83, intending to draw in retail investment. Once sufficient positions were established, they abruptly reversed course. In this urgent market analysis, we will meticulously examine the mechanics of this $9 price swing. We will scrutinize the shooting star candlestick pattern forming on the daily chart. We will elucidate why this pronounced volatility is, in fact, beneficial for the long-term trajectory, despite its unsettling immediate impact. Most crucially, we will demonstrate why the actual physical value of silver did not decrease by $9 today. The paper market is being violently buffeted, akin to a flag in a tempest, yet the underlying support structure remains exceptionally robust. This is the narrative of Monday's price manipulation. To comprehend silver's descent from $83, one must first understand who was purchasing at that elevated price. It was not the astute capital. The astute capital had acquired silver at $30 and $50. Those acquiring silver at $83 during the Sunday night gap opening were the trend followers, the individuals driven by the fear of missing out. These were the participants employing 10-to-1 leverage, eager for rapid wealth accumulation. Financial institutions maintain extensive databases. They are precisely aware of the locations of these traders' stop-loss orders. A stop-loss is an automated sell order that executes when the price falls to a predetermined level. The majority of individuals purchasing at $80 likely set their stop-loss at $75. Consequently, the institutions engineered the price decline. They executed a substantial sale of futures contracts at the peak price. This action initiated the price reduction, which fell to $79, then $78, and subsequently reached the $75 stop-loss zone. Instantly, thousands of retail sell orders were triggered simultaneously. This precipitated a cascading effect, a torrent of selling pressure. The price then collapsed to $74.47, exclusively due to these compelled liquidations. And who do you suppose was poised at $74 to repurchase the metal? The very same institutions that had sold it at $83. They divested at a premium, compelled others to liquidate at a discount, and then reacquired those positions at a reduced cost. This practice is referred to as rinsing the leverage. It is a harsh, albeit market-sanctioned, method of purging speculative excesses before the next upward movement. Now let us direct our attention to the chart configuration. From a technical standpoint, this particular candlestick is termed a shooting star or a high-wave candle. It is characterized by a small body and an exceptionally elongated upper shadow. This shadow signifies market rejection, indicating that despite the market's attempt to reach $83, sellers successfully pushed the price back down. Typically, a shooting star pattern suggests a temporary halt in momentum. It implies that buyers have expended their energy, they have ascended the incline and are now fatigued. we should anticipate a period of price consolidation. The price may oscillate within the $75 to $80 range for several days. Do not expect a continuous upward trajectory tomorrow. The market requires time to process this significant price movement. However, here is a crucial piece of data. Observe the closing price in relation to Friday's close. We concluded Friday's trading at $71.91. Presently, we are trading around $78.36. Despite the substantial decline from the highs, we remain in positive territory. We have appreciated by nearly 10% from last week's closing value. If you disregard the upper shadow and the $83 price spike, this still represents a considerably positive trading day. The upward trend remains intact. The breakout is still valid. The sole alteration is that the phase of effortless gains has concluded. We are now entering a period of pronounced price fluctuations. Let us now consider gold. Gold is currently priced at $4,514, showing a modest decrease of approximately $4. This represents stability. While silver is experiencing turbulent price swings, gold is holding steady at its all-time high. This indicates that the prevailing monetary system continues to exhibit fundamental weaknesses. Gold serves as a stabilizing anchor. As long as gold maintains its position at $4,500, the underlying support for silver remains secure. Silver is merely exhibiting characteristics of a more volatile asset class, prone to overshooting in both upward and downward movements. This volatility represents the cost of participation. To benefit from silver's potential gains, one must endure its price oscillations. If you experience panic when the price fell to $74, it implies you were excessively leveraged. Holders of physical silver did not panic. They observed the price drop on their screens and then returned to their daily routines, fully aware that an ounce of silver remains an ounce of silver. We must revisit the ghost week factor. We had previously cautioned that low trading volume can create price vacuums. Today served as definitive confirmation. The ease with which the price could drop $9 is attributable to the absence of buyers in the intermediate price ranges. The order book was essentially empty. The price descended through this void until it encountered the preset buy orders from institutional investors, often referred to as whales, positioned at $75. Notably, the bounce occurred around $74.47. The reason for this level is that $75 represented the breakout point from the previous week. Historically, resistance levels often transform into support levels. The market retested this breakout point and it held firm. This is textbook technical behavior, validating the $75 floor. The aforementioned whales were anticipating this level and intervened, aggressively purchasing during the price decline, driving the price back up to $78. This confirms the substantial industrial demand. Major corporations like Samsung and Tesla did not chase the price to $83. They are far too prudent for such actions. They waited, allowed the financial institutions to exert downward pressure, and subsequently acquired advantageous contracts at $74. Smart capital prioritizes purchasing during periods of weakness. In contrast, less informed capital tends to buy during periods of strength. Today's events illustrate a transfer of wealth from less informed participants to more astute ones. We will delve deeper into this analysis by examining the physical market's reaction. Did dealers reduce their pricing when the spot price fell to $74, or did they maintain their elevated premiums? Furthermore, we need to assess the setup for January. Will this shooting star candlestick disrupt the anticipated January effect, or will it merely present a more favorable entry point for institutional investors? The price manipulation was undoubtedly painful, but it effectively cleared out excess positions. The leverage positions have been eliminated, and the less committed investors have departed. Consequently, the genuine market can now reassert itself. Remain engaged as we continue this in-depth exploration. We will ascertain the condition of the physical supply chain. It is imperative that you do not allow the current price volatility to unsettle you. We must address the disconnect between the physical and paper markets. While the paper price was plummeting from $83 to $74, what was occurring at local coin shops? Did the dealers lower their prices by $9? Did they announce, "Oh look, The commodity prices have crashed. Let's sell silver at a reduced rate. Absolutely not. Their pricing remained largely unchanged. In fact, some dealers actually increased their premiums. This is the most critical indicator for physical silver investors. The spot price experienced a significant decline, yet the retail price remained firm. The reason for this is that dealers understand that the paper market's volatility is largely artificial. They are aware that if they sell a Silver Eagle coin at $78 and the price subsequently rebounds to $83 within an hour, they would incur a loss. They are unwilling to engage in speculative trading with their physical inventory. They regard physical silver as a stable store of value, while the paper price is perceived as a flawed gambling mechanism. Therefore, if you were anticipating a price dip to acquire physical silver, you likely missed the opportunity. The window to purchase at $74 was likely open for a mere 15 minutes, and even then, the websites were probably experiencing technical difficulties or indicating out-of-stock status. This underscores that the price dip was a paper-driven event, not a reflection of physical market dynamics. There was no surge of physical silver being sold, nor was there a line of individuals attempting to offload their bullion. The decline was solely the result of a computer algorithm dumping futures contracts. This divergence is paramount. In a genuine bear market, physical investors would engage in panic selling. In a manipulated stop hunt, physical investors maintain their positions. We observed adherence to positions and prevailing strength. The market's foundation is exceptionally solid, even if the upper echelons are experiencing temporary turbulence. Now let us examine the industrial sector's response. We previously discussed the institutional whales purchasing during the price dip. Imagine yourself as the procurement manager for a solar energy company. You require silver and you have a defined budget. You witnessed the price reaching $83 this morning, which likely caused considerable concern. Subsequently, you observed it fall to $74. Did you panic? No. You likely celebrated. You would have immediately initiated a purchase order through your hedging software. This $9 price drop represented a fortuitous opportunity for the industrial sector. It enabled them to secure inventory at a reduced cost before the year's end. They effectively leveraged the bank's manipulation to their advantage. The banks deliberately depressed the price to liquidate speculators, but in doing so, they inadvertently provided industrial users with an advantageous entry point. This explains the strong rebound from $74 back to $78. The industrial sector stepped in, absorbing the paper selling and converting it into requests for physical delivery. This action establishes a higher low. Last week, the support level was $65. This week, the support level appears to be $74. We are constructing a stair-step pattern, with each subsequent step being higher, indicating an upward trajectory. Let us discuss the volatility tax. Volatility effectively acts as a tax on leverage positions. If you were trading futures, options, or on margin today, you were likely wiped out, having paid this tax. However, if you held physical silver, you incurred no such cost. Your ounce of silver remains an ounce of silver. Furthermore, you gained valuable insight. You now understand that the market is capable of reaching $83. You have witnessed the potential. The spike to $83 provided a glimpse into the future, illustrating the price's upward potential when market suppression is momentarily lifted. It was a preview of price discovery. Consider it analogous to holding a beach ball submerged underwater. For a brief instant, your grip loosened and the ball shot upwards to $83. Subsequently, the institutions reasserted control and pulled it back down to $78. However, we now comprehend the stored energy within that ball, realizing that $83 is not an ultimate ceiling, but merely an initial milestone. We must also examine the currency exchange rates. Silver did not merely decline against the US dollar today. It depreciated against all major currencies before subsequently recovering against them. The US dollar index remained relatively stable, indicating that the movement was specific to silver, not a broad macroeconomic event, nor a change in interest rates, nor a geopolitical resolution. It was an internal market dynamic. Positions were excessively weighted on the long side, causing the market to become unstable. Subsequently, it has corrected itself. This cleansing event is, in fact, bullish for January. Had the price surged directly to $100 without a correction, the subsequent decline would have been catastrophic, potentially terminating the bull market for an extended period. By experiencing a sharp decline now, by purging leverage at this juncture, we reset open interest and clear the path for new capital inflows in January. The institutional investors we mentioned are pleased. They were reluctant to purchase at $83 and are now content to acquire at $78. The market has effectively become more attractive to institutional investment. Let us analyze the psychology of the candlestick's upper wick. The lengthy upper shadow on the chart is a cause for concern. It signifies rejection, indicating that technically sellers overwhelmed buyers at $83. This establishes a resistance zone. For the upcoming days, $83 will present a considerable hurdle. Traders who purchased at the peak are now holding depreciated assets. When the price approaches $83 again, they will likely sell to recover their initial investment, thereby creating an overhang of supply. Consequently, do not anticipate an immediate surge past $85 tomorrow. We must absorb this excess supply and undergo a period of consolidation. The price is likely to trade sideways between $75 and $80 for some time. We need to allow the moving averages to converge. This sideways trading environment is often the most challenging to navigate. It is designed to induce boredom. The volatility will subside and the excitement will dissipate. It is precisely at such moments that the next significant move is likely to occur. However, there is an unpredictable factor: gold. Gold is trading at $4,514, showing minimal movement. It did not experience a flash crash or a significant spike. It simply maintained its position. This stability serves as the anchor. If the silver market were fundamentally flawed, if the bull run had truly concluded, gold would have also experienced a downturn. The fact that gold is holding steady at $4,500 signifies that the monetary premium remains intact. Silver simply advanced too quickly, becoming somewhat overextended. Gold, acting as the more experienced participant, is signaling a need for a more measured pace, acknowledging that the overall trend remains upward. Observe the gold to silver ratio. At $83, the ratio declined into the 50s. At $74, it reverted to 60. Currently at $78, it hovers around 57. This compression indicates that silver is still outperforming gold. Even on a day marked by a price decline, silver demonstrates relative strength compared to its position a week prior. Last week, we were celebrating a price of $65. Today, we express disappointment with $78. This represents a shift in perspective, a testament to how perceived wealth can influence our emotional responses. You are disappointed at not becoming wealthier more rapidly, yet your financial position has improved. Let us revisit the discussion regarding the solvency of financial institutions. We previously alluded to a Lehman moment. Did any financial institution face collapse today? The 10% price swing suggests that some entity was in a precarious position. The sharp decline from $83 might have been the liquidation of a fund that had taken on excessive risk. Alternatively, it could have been a desperate short position by an institution attempting to defend the $80 level. If it was an institution defending $80, they expended considerable resources. They utilized a significant volume of paper contracts to drive the price down by $9, thereby increasing their short position. They deepened their financial exposure. While they may have secured temporary relief, they amplified the potential for a subsequent surge. They have postponed the inevitable, but the burden has intensified. Now let us examine the volume profile of the price decline. The trading volume during the ascent was substantial. The volume during the descent was also elevated, but it was driven by panic. Typically, panic selling is short-lived and quickly dissipates. Structural buying, conversely, is sustained and can persist for months. The buying observed at the market opening and during the price dip represents structural demand. The selling, conversely, was tactical. In the long run, structural demand consistently triumphs over tactical selling. Therefore, What is the strategic approach for the remainder of Ghost Week? We have 3 remaining days before New Year's Eve. Liquidity is expected to remain constrained. The price manipulation we just witnessed could occur again. We might observe a sudden price movement to $70 or $85. The theory of a random walk is fully operative with a distinct lack of responsible oversight. Your primary objective is to avoid being caught in the crossfire. Do not place stop-loss orders within the trading system. If your stop-loss was set at $74, you were liquidated today, selling precisely at the low point, and are now observing the price trade $4 higher. This is a regrettable outcome. The sole method to avert such disappointment is to remove stop-loss orders. Trade with positions small enough to negate the need for a stop, or hold physical silver where stop-loss mechanisms are irrelevant. We must prepare for the monthly closing. Wednesday, December 31st, marks the end of the month and the year. The monthly and yearly candlestick formations will be finalized. If silver concludes the month above $75, it will represent the highest monthly closing price in its history. This will create a substantial bullish candlestick on the yearly chart, signaling to institutional investors for the upcoming year. Silver will be recognized as a significant performer. Even with the upper wick and the rejection at $83, a closing price of $78 signifies a triumph. It solidifies the basis for the January effect. Therefore, do not allow the intraday price fluctuations to obscure the overarching yearly trend. The year is concluding on a positive note. The price volatility represents the noise, while the price level itself conveys the signal. We are currently trading near $80. If I had conveyed this prediction a month ago, you would have likely dismissed it as improbable. Now, you are expressing dissatisfaction that it's not yet $90. This indicates progress. In the subsequent segment, we will examine the January market outlook. We will analyze how the shooting star candlestick influences algorithmic trading decisions for the upcoming week. Will it deter them, or will they perceive it as an advantageous purchasing opportunity? Additionally, we will provide a comprehensive checklist for the end of the year detailing the necessary actions to ensure preparedness for the tax year transition. The price manipulation served as a test. You have successfully navigated it. Now let us prepare for the subsequent phase. We need to understand the mindset of automated trading systems. Financial markets are largely governed by algorithms, particularly those employed by commodity trading advisors. These automated systems manage hundreds of billions of dollars. Presently, they are analyzing the shooting star candlestick on the daily chart and recalculating their strategies. To human observers, a shooting star appears as a failure, suggesting an attempt to ascend that was forcefully curtailed. However, to an algorithm, it represents heightened volatility. Algorithms inherently dislike volatility. When prices fluctuate by $9 within a single day, risk metrics escalate significantly. The automated systems perceive the market as unstable, necessitating a reduction in position size. Consequently, over the next 48 hours, we may observe a moderation in aggressive buying by these algorithms. They might adopt a more cautious stance, allowing the market to drift. This dynamic contributes to a period of price oscillation. It is probable that silver will fluctuate between $75 and $80, akin to a ping-pong ball experiencing minor upward and downward movements. This range-bound trading is strategically designed to impact options traders. It erodes the time value of call options and frustrates momentum traders who seek immediate gains. It is akin to the spin cycle of a washing machine, purging excess leverage before the garments are thoroughly cleansed. However, here lies a crucial insight. Algorithms operate with a short-term perspective, focusing on daily volatility. Institutional investors, such as pension funds that will enter the market in January, adopt a long-term outlook, prioritizing monthly trends. The monthly trend in this instance is demonstrably upward. When a pension fund manager observes today's price decline, they do not perceive a shooting star pattern. Instead, they see a discount. They recognize that silver was previously priced at $83, and they now have the opportunity to acquire it at $78. This represents a saving of $5 per ounce on a $1 billion investment, a significant advantage. Therefore, the price manipulation actually enhances the likelihood of the January effect. Had the price remained at $83, These funds might have hesitated, perceiving it as overly extended. However, at $78, it appears as a bargain relative to the recent high, fostering a buy-the-dip mentality among institutional capital. The price correction has effectively cleared the airspace, allowing for the arrival of larger investment aircraft. Let us consider the monthly closing. Today is Monday, December 29th. We have 2 remaining trading days in both the month and the year. Wednesday, December 31st, is the concluding deadline. For technical analysts, the monthly candlestick formation provides the most significant chart signal. If silver concludes the month above $75, it will represent the highest monthly closing price in its history. This formation would essentially encompass the price action of the preceding 10 years. This signal is so potent that it supersedes daily price volatility. It informs long-term trend followers that the bear market is mathematically concluded and that a new secular bull market has commenced. Secular bull markets typically span 10 to 15 years and are not significantly impacted by a $9 price drop on a Monday. Therefore, the critical battle for the next 48 hours is straightforward. The bulls must defend the $75 level. The bears must push the price below $70. Currently, trading at $78.36, the bulls possess a $3 buffer. They are in a commanding position and simply need to maintain their advantage until New Year's Eve. Let us again consider the psychology of individual market participants. Imagine you are the chief executive officer of a mining company such as Hecla Mining or First Majestic. You witnessed the price reach $83 today. Did you rush to sell your production? No. You observed the volatility and the evident manipulation, recognizing that the market is fundamentally flawed. When a market is perceived as broken, producers tend to distrust the exchange. They cease forward sales and hedging activities, opting instead to retain their physical metal. It is plausible that we are witnessing a form of protest or a deliberate withholding of supply from the mining industry. They are effectively stating, we will not sell our silver into a volatile, manipulated environment. We will wait until the price stabilizes at triple digits. This action removes supply from the market precisely when financial institutions require it most. The institutions are aggressively selling futures to cover their short positions. However, they can only achieve this if there are willing sellers. If the mining companies are not selling and physical holders are not selling, from whom did the institutions acquire silver today? They purchased from leveraged speculators who were facing margin calls. They essentially absorbed the positions of the less resilient investors. However, once these weak hands have been eliminated, who remains? Only the strong hands. And the strong hands are not selling at $78. This leads us to the physical inventory data. We must closely monitor the COMEX reports this week. Typically, when the price experiences a downturn, inventory flows into the vaults as sellers liquidate their holdings. However, observe tomorrow's reports. I anticipate we will see inventory outflows. Even on a day of price decline, metal is being removed from the vaults. The reason for this is that industrial buyers such as Samsung, Tesla, and major solar energy firms utilize the price dip to take physical delivery. They observed the price plummet by $9 and declared, "Thank you, we will acquire 10 tons." The actual market is being depleted while speculative traders are squabbling over insignificant price fluctuations. A decline in available stock concurrent with a falling price indicates a positive divergence, suggesting that the price itself is misleading. The scarcity of the commodity is intensifying, not abating. Furthermore, we must address the matter of geopolitical hedging strategies. The contemporary global landscape is fraught with peril, marked by escalating tensions in the Middle East and the South China Sea. Silver serves as a hedge against conflict, not solely due to its incorporation in missile technology, but crucially because it carries no counterparty risk. In the event of war, stock markets would shudder and bond markets would seize up. However, gold and silver stored securely in a vault would retain their value. Savvy investors utilize the Ghost Week period to safeguard against risks associated with the new year. What if an unforeseen event occurs on January 1st? What if a currency experiences devaluation? Investors are channeling capital into silver as a secure refuge. This influx of demand for safe haven assets is establishing a price floor, preventing a precipitous decline. Individuals are hesitant to hold cash during the holiday season. While $78 might seem substantial, the prospect of possessing $0 due to a bank failure is far more daunting. Let us now consider the shift in unit bias. We have previously discussed this phenomenon, but its progression is exceeding our initial projections. At $83, silver is no longer perceived as an inexpensive metal. It is regaining its status as a precious metal. This psychological recalibration influences buyer behavior, leading to the departure of bargain hunters and the arrival of momentum traders alongside asset allocators. When silver was priced at $20, its market capitalization was too modest to attract significant institutional investment. At $80, the market capitalization has quadrupled, reaching a size sufficient for mid-tier hedge funds to establish positions without causing market disruption. Increased prices invariably attract larger capital inflows, a manifestation of the Soros reflexivity loop, where the price increase itself alters the fundamental dynamics of the market, thereby validating the asset class. Consequently, the price correction from $83, though painful to witness, was a necessary purging of speculative tourist money. This allowed institutional capital to enter the market and set the stage for the monthly close. As we approach Tuesday and Wednesday, expect market choppiness. Anticipate efforts by financial institutions to suppress the price, aiming to keep it below $80 for the year end. However, the underlying trend possesses an inexorable force akin to a river. While a dam can temporarily impede its flow, persistent rising water will eventually breach it. The water level is indeed rising. In our concluding segment, we will provide a comprehensive year-end checklist outlining the essential actions to be taken before December 31st. Should you acquire the dip? Should you rebalance your portfolio? And I will offer my definitive assessment of the shooting star candlestick pattern. Does it signify a market top or a midpoint in the trend? The answer is found in historical precedent, and history indicates that we are merely at the nascent stages of this movement. Stay tuned. As we conclude the most turbulent trading day of the year, we have reached the final segment of this special broadcast. We have meticulously analyzed the dramatic price collapse that propelled silver from $83 down to $74 before recovering to $78. We have exposed the manipulative stop hunts, scrutinized the panic selling driven by institutional fear, and evaluated the resilience of the physical market. Your portfolio may now resemble a post-battlefield landscape. The day's volatility has been so extreme that it could induce motion sickness in even the most seasoned trader. Yet if you have persevered and refrained from selling at the low, you are a survivor. You have weathered the orchestrated rug pull, and in a bull market, survival is the essential prerequisite for eventual triumph. In this final breakdown, Part 4, I will present your essential year-end checklist. We have 48 hours remaining in the trading year. I will precisely guide you on how to position yourself for the final closing bell of 2025. I will deliver my definitive judgment on the shooting star candlestick. Is it a cautionary signal or an opportune invitation? And I will equip you with the necessary mindset to confidently enter the month of January. The tempest has subsided and the vessel remains afloat. Now let us chart our course. Here are the critical steps you must undertake before Wednesday evening. First, thoroughly audit your leverage. If today's $9 price swing elicited a visceral negative reaction, your leverage is excessively high. You are employing too much margin and have an overabundance of options contracts. Utilize the remaining 2 days to mitigate risk by divesting some of your leverage positions and reallocating capital into physical precious metals or fully owned mining equities. The volatility expected in January will likely surpass that experienced today. Therefore, ensure your position is robust enough to withstand a $10 price decline without forcing liquidation, maintaining an unshakable resolve. Second, vigilantly monitor the $75 level. This represents your critical support threshold. Today's bounce from $74.47 has confirmed $75 as a firm floor. As long as the price remains above this level, the breakout remains valid. Any subsequent dip to this mark should be viewed as a buying opportunity, whereas a definitive breach would necessitate a reassessment of our strategy. For now, $75 is your impenetrable fortress. Defend it. Third, disregard the short-term market fluctuations. Over the next 2 days, trading volumes will be exceptionally low, leading algorithms to generate misleading candlestick patterns and widen bid-ask spreads. Resist the urge to constantly monitor your screens. Instead, set price alerts and step away. This period of market choppiness is intentionally designed to deplete trader capital. Do not engage in this rigged game. Now, let us render a final verdict on that unusual candlestick pattern. Technical analysis literature typically classifies a shooting star as a bearish reversal signal, indicating a market top. However, context is paramount. A shooting star at the conclusion of a protracted, exhausted trend is indeed bearish. Conversely, a shooting star occurring at the commencement of a breakout, exacerbated by low holiday trading volume, often serves merely as a temporary pause, representing a clearing of speculative positions. The market attempted to advance too rapidly, prompting a brief pullback. I interpret today's price action not as a reversal, but as a liquidity test. The market probed $83, encountering selling pressure, and then tested $74, finding buyers. It has now established its trading range within which it will likely fluctuate until new capital enters in January. Do not allow a single daily candle to derail your conviction in a multi-month trend. The weekly chart continues to exhibit strength. The monthly chart resembles a skyscraper, and the daily chart represents mere noise. Looking ahead, we are mere days away from 2026. If 2025 was the year silver awakened, 2026 will be the year it reclaims its role as a monetary asset and a strategic reserve. The conditions for January are exceptionally favorable. Speculative leverage has been purged. A strong price floor has been established. Gold has signaled strength at $4,500, and a substantial influx of capital from pension funds is anticipated. I am confident that $83 will be surpassed within the initial 2 weeks of January. Today's wick is not a ceiling, but rather a target, as markets tend to fill such price extremes. The price will revisit this level to ascertain the presence of lingering sellers. However, those sellers have already exited their positions today. We foresee a clear trajectory towards $100, potentially materializing in the first or second quarter. The underlying physics of supply and demand dictates this upward trend. Therefore, the conclusion is as follows. Today was designed to be intimidating. If it were easy, everyone would be wealthy. The market compels participants to earn their gains by enduring volatility. You have endured it, held your ground at $74, and continue to hold at $78, demonstrating unwavering resolve. Now take a moment to relax. The year is nearing its end. You have strategically positioned yourself in the sole asset class, offering protection against a debt-induced collapse and exposure to the burgeoning energy sector. You have completed the arduous task. Now, allow the January effect to facilitate further gains. Enjoy the new year, secure your holdings, and prepare. If today's events seemed extraordinary, imagine the impact when significant capital enters the market. The attempted rug pull failed to derail the established trend. The bull market remains intact and is poised for further ascent. Subscribe.